This week, housing values, inflation, and the U.S. economic forecast.
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
Welcome back. Will an economic hangover following the COVID-19 pandemic leave the U.S. economy and housing market reaching for a heavy dose of Tylenol? Economists and housing experts' opinions fall between prognostications of doom and gloom to sunny optimism. However, outside of those two extremes lies some interesting details that you, as a reverse mortgage professional, may want to keep in mind. A February 8th headline in Housing Wire reads, "The last stand for forbearance housing market crash, bros." Now, just as those who contracted the COVID-19 infection may continue to struggle with ongoing health problems in the wake of that, our economy remains vulnerable to a glut of over 2.7 million, to be precise, of mortgages that are in forbearance. The vexing question is, how will those loans and arrears be unwound in such a way as to not damage a fragile economy? However, data does reveal that those unraveling of those problematic loans may be actually less onerous. The volume of those seeking forbearance has in fact dropped significantly, that according to a report from Black Knight. Another scenario is that the U.S. government will continue to move the goalposts for mortgage forbearances, and that's a strategy that we've seen employed repeatedly in recent months over two administrations. Then there's the underlying quality of the homeowner's credit of those who are in forbearance. Housing Wire columnist Logan Latashami writes, "This is critical to the story. Homeowners' credit profiles. When they originated their loans, they were excellent. The previous expansion had the best loan profiles I have seen in my life. These buyers, especially those who purchased loans from 2010 to 17, have fixed low debt costs due to low mortgage rates with rising wages and nested equity." Now, granted, in the wake of the housing crash of 2008, improved lending standards have reduced the prevalence of over-leveraged borrowers. However, that may be inconsequential for those who have actually lost their job and remain unemployed. It would seem that the unwinding of loans and forbearance will depend upon job recovery rates and falling unemployment claims. Is the specter of inflation looming ahead? The insurance giant ING says that the only way inflation can go is up. Headline U.S. inflation has risen from 0.2% last May to 1.4% today and is likely to sail well above 3% in the coming months, says the column. The Fed has said they're going to look through a temporary spike, but there is a growing sense that inflation could be stickier, potentially forcing them into earlier action on interest rates than they are currently signaling. Put simply, while the Fed is pumping trillions of dollars into the economy, there are limits to such measures should inflation begin to spike too fast. Now, those considerations leave one to wonder if the Fed is being much too sanguine in signaling that there's going to be no significant interest rate hikes in the coming year or two. And speaking of sanguine, Goldman Sachs has boosted their prediction of the U.S. economy's GDP to a staggering 6.8%. Such unheard of GDP numbers may appear dubious, but keep in mind that as more Americans are vaccinated and return to work, the bounce back from an economy that nearly pancaked may not be quite so far-fetched after all. Economists at the bank raised their forecast for 2021 U.S. gross domestic product growth to 6.8% from 6.6% and to 4.5 to 4.3% in 2022, reads the Business Insider column. The investment bank does expect the Federal Reserve will not increase interest rates until the first half of 2024 in light of their upgraded GDP forecast and also improved unemployment figures. Now, all things considered, despite the COVID-19 pandemic and economic uncertainty, housing prices are expected to remain stable. Inflation remains an economic wildcard in the recovery effort, but the economy is actually poised to post record growth after a historic contraction. Now, each of those factors, individually and collectively, bode well for modest or even significant growth of the reverse mortgage market. Now, what are your thoughts? You can leave your comments in the comment section below. And also, if you'd share this video with others using the social media links found on this page. Thanks again for watching. Be sure to return next week for more reverse mortgage news, commentary, and analysis here at the Industry Leader Update.